I'm Grant Walker. Welcome to Last Call for Monday, the 6th of July. I'll be back with Heads Up Tuesday, 10 a.m. In market news, the owner of Sam's Creek Gold Project, which sits atop what could be New Zealand's biggest undeveloped gold deposit, has slashed the value of the resource and taken impairments of about $7.7 million after stopping work on the site last year pending a pickup in prices. Sam's Creek Gold Limited, which is owned by ASX-listed Mod Resources, posted a loss of $7.3 million in calendar 2014 from a year earlier profit of $1.2 million. Sam's Creek in the South Island's Golden Bay region isn't producing, so the company has no revenue. According to its accounts, Sam's Creek took an impairment charge on the future recoverability of exploration expenditure of about $6.6 million, slashing its value to $3.1 million from $9.5. The company adopted that $3.1 million as the appropriate carrying value of the project as at December 31, about the midpoint of an independent valuation it commissioned of about $2.3 million to $4.3 million. The accounts show it also impaired all of the $1.1 million investment interest in the project in 2014. Mod Resources has a 60% interest in the Sam's Creek Gold Project, with the remainder held by Oceana Gold. Mod Resources farmed into the project by funding the staged exploration program and issuing shares to Oceana Gold, and has the opportunity to reap up to 80% of eventual earnings. Sam's Creek is its second project after the Mihumo copper-silver project in Botswana. Exploratory drilling in 2013 intersected numerous high-grade gold zones, including 19.6 metres of 6 grams of gold per tonne of raw material. The total resource was estimated at 1 million ounces of gold. In July last year, drilling at Sam's Creek was put on hold in the face of weaker prices for gold and is expected to resume when there is a sustained improvement and Mod can secure funding to advance the project towards potential production. In Mod Resources' first quarter activities report, the company describes Sam's Creek as a substantial gold deposit with excellent potential for extensions. The spot price of gold peaked at US $1,920.30 an ounce in 2013 and was recently at $1169.01 an ounce, a decline of almost 40%. Mod Resources shares last traded at 0.04 cents Australian on the ASX and have shed 88% of their value in the past 2 years. Oceana Gold were last at $3.16 and have soared 139% in the past 2 years. Banking and the courts. A David and Goliath interest rate swap case opened in the High Court of Auckland this morning, which, if successful, could have wide-reaching impact on the banking sector. Small North Island motel chain Silver Oaks Group is suing Westpac for allegedly pressuring it to buy interest rate swaps that lost it $3 million and instead benefited the more informed Westpac. The swaps transactions, which provide fixed interest rates that help borrowers when rates are rising but cripple them if rates decline, were entered into in October 2008, just as interest rates began to decline in the global financial crisis onslaught. Silver Oaks lawyer John Turner claimed in court this morning that Westpac neglected to talk about or downplayed the possibility of interest rate falls, which would leave anyone holding swaps exposed. Mr. Turner said while the swaps may have been suitable for large customers such as Air New Zealand or Microsoft, they were inherently unsuitable for smaller and relatively unsophisticated customers such as Silver Oaks. The motel group is trying to prove Westpac engaged in misleading and deceiving action, negligent misstatement, contractual misrepresentation, breach of duty of care and negligence, breach of fiduciary duty, and breach of bank and customer contract. Mr. Turner alleged Westpac pushed the product, which had considerable benefit to the bank, particularly in the onset of the GFC, onto customers such as Silver Oaks because it helped the bank's liquidity, let the bank hedge its own external borrowing costs, and keep an unnaturally high interest rate at a time when rates elsewhere were dropping. But he said the product was inherently risky and not suited to the customer's needs. These risks were not made known to the plaintiffs. The bank, with its many analysts and economists, knew well interest rates were dropping. It knew it could make some money from pushing interest rate swaps. Each month the bank made money, far from saving the customer money, and the overall effect was disastrous. Mr. Turner said Silver Oaks was locked into a contract for 3 to 5 years unless it paid a termination charge it could not afford. Once on board, Mr. Turner said it was stuck there for the term of the swap. It started to make horrendous losses, but stuck with that situation under pain of paying onerous termination charges. That's why the swaps are controversial, he said. If interest rates go the wrong way, as did in this case, then the customer is effectively on a roller coaster that's going down into a very deep hole. Family-owned Silver Oaks was almost crushed by its $17.9 million Westpac debts. shrinking from 6 motels to 4 and forced into receivership. The group was refinanced by ANZ before launching the civil claim against Westpac. Mr Turner will call on 2 expert witnesses over the next week, who he said will talk on the deficiency on interest rate swaps. These products, he said, are certainly not uncontroversial. It's really a refined form of adult gambling, as our expert witness will say. Lawyers for Westpac deny the claims and are expected to start their defence next Monday, with the case likely to run over 2 weeks before Justice Pamela Andrews. The case is being closely watched by the banking and regulatory sector since it's a test case into the legitimacy of the widely sold swaps. It's understood Westpac and others sold hundreds of millions of swap contracts between 2008 and 12. ANZ, ASB Bank and Westpac recently settled with the Commerce Commission and FMA for more than $24 million after an investigation into how the 3 banks sold interest rate swaps to rural customers.
NBR Radio, Monday the 6th. I'm John Stewart, and I'm joined by our telecommunications editor, Chris Keel. The internet startup company that created the controversial global mode technology has rebounded from its recent legal setback by signing a deal with an Australian ISP. Now, Chris, can you just remind us what the legal setback was?
Yes, we had Global Mode. It's a small Auckland company, just 4 people. They created a little bit of technology that allowed everyone who belonged to an ISP access services like Netflix US, BBC iPlayer, Amazon Prime that are usually geo-blocked to New Zealanders. We had Sky TV, TVNZ, MediaWorks and Spark take legal action. They said it was a breach of the Copyright Act and Fair Trading Act. We were looking forward to that High Court stoush. They both had their arguments, but Call Plus and Bypass Network Services, the creator of Global Mode, both unexpectedly threw in the towel and settled ahead of the court case. Right. In Global Mode's case, I think they were just too small to fight 4 big media companies. Call Plus had the complication that it had just been sold to an Australian company called M2, who possibly didn't have the stomach for another copyright fight.
So who's the Australian ISP?
It's a mob called YourNet. They're not going to launch until August, but they're going to specialise on video streaming, which has obviously become quite the hot thing here. It's accounted for a lot of total internet traffic in New Zealand, and they're going to offer quite expensive plans, $129 a month, but they're going to be trying to attract the audience that's really keen on streaming video from overseas sites, and they're going to use Global Mode's technology to do that. So
what sites will be available to Kiwis who want to access all of these?
All the people who join this new ISP YourNet in Australia will be able to access all the sites that people who belong to Call Plus, before it chickened out of its legal case, used to be able to access here. But the Global Mode guys were pointing out to me this morning that beyond this Australian deal they've scored, they're lining up a deal with a mob called Indonesian Cloud in Indonesia, which will allow people there to access geo-blocked content. And there's also an internet filtering element there because there's quite strict censorship laws around. You can't have violence on screen or sex scenes even extending to something mild like kissing.
That's going to cut the choice down rather a lot, isn't it?
So the Global Mode guys are also working on a second product called Bodyguard, which has been aimed at families who are worried about what their children are surfing to. So when the Indonesian authorities, and they're looking to comply with laws there, want to filter what people can look, then Bodyguard technology can presumably factor in there as well. And they're also fielding a lot of inquiries from Europe, where the European Union has sort of eliminated geo-blocking throughout the EU. So everyone within the EU can access streaming services from anywhere there, and ISPs are looking for a little bit of technology to help make that happen. So Global Mode's looking to, what sounds like they're lining up some business there as well.
So people living here in New Zealand who are maybe French or German speakers or whatever will be able to access programs in their original home languages, if you like.
Well, if they join an ISP there, I think they're just looking to really export the technology to ISPs in Europe.
Indeed. But not cheap for New Zealanders. I think you said $129 subscription to go through the Australian.
That will be for the people who join the Australian ISP, who'll probably be mostly Australian natives, I'd assume. Yeah.
Yeah, so, but do you think people who've got by for some years on Sky subscriptions will cancel those and go over to this SVOD way of accessing programs and movies?
Yeah, we're still not sure. We had a survey on our website last week, some polling taken by Horizon, which indicated that we've started to get some quite serious Netflix uptake here, several 100,000 users. So you can see why Sky TV is trying to get in on the action with its own Neon. They won't say how many Neon subscribers there are yet, but I was talking to someone from Sky TV late last week, and they did note that subscriptions to the Soho channel, which has a lot of the HBO content that also screens on Neon, have actually increased since they launched Neon. So it seems like Neon could in fact be quite a good taster for the full-blooded Soho channel.
A rapidly developing situation. We'll obviously be keeping an eye on it. Thanks very much for that, Chris.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio, Monday the 6th. I'm John Stewart. It's time for our weekly currency markets talk, and with me is our macroeconomics reporter, Jason Walls, and the GM of CMC Markets, Chris Smith. Jason, obviously all eyes are on Greece right now, so this morning we had news of a likely no vote. What's the impact been of that on the euro?
Yeah, well, we saw that the Greek people overwhelmingly was the word that's been thrown around in a lot of other in countries in the world in the media, that they rejected the vote. So they voted no, it's obviously going to have huge implications going forward, because the Greek government was saying, we want our people to vote no. However, the European Union and some of their creditors were urging them to vote yes. So, I mean, what did you see, Chris? Initial
Yeah,
thoughts?
Morning, Jason. Morning, John. The reaction this morning, we saw the euro off 1%, initial bids down to around 109. It's recovered slightly. We'll get a lot of impact tonight when the equity markets reopen, certainly in Europe. We'll start to get more news coming out today. The key event will be the ECB's line of credit to the banks. Will the banks reopen? Will the ECB backstop those banks which need to, open tomorrow morning? And then we have now a scheduled meeting on Tuesday between the French Prime Minister and German Minister to, what do they do? I mean, it's good for the Greek people probably, having a no vote. A lot of people have been unemployed over there for a very long time. They've had the new cabinet in power for 5 months, and they've been pressing for change. Germany really hold all the decision-making ability, I think. They hold most of the debt, and they need to decide, are they going to cut that debt in half or have any reduction?
Yeah, and Merkel's not happy at all about this. I mean, she's been very vocal in the fact that they need to make some changes, and all the creditors have as well. So this would be a huge kick for her, because she wants to keep Greece in the Eurozone, but at the same time, she wants them to kind of, very politely behave themselves in a way.
Yeah, of course. So the ECB have to really contain this, any contagion. They have to make sure this does not spread to Spain, Portugal, other countries. Global markets hate uncertainty, but Greece is such a small piece of the world puzzle, 2% of GDP in Europe. China is the much bigger story, but obviously Greece is in the headlines right now because it's a monumental time. They could leave the euro, and it could very likely happen by the end of this week if the European leaders really just stand their ground and force Greece to actually do leave and default.
So you think it could be potentially by the end of this week we could see the Grexit?
Depends how that Tuesday meeting goes. I mean, probably unlikely that quickly, but things can escalate very quickly. We've seen it with the banks. We've seen the ATMs running out of cash. It can heighten. And I'm sure they have been working on Plan B. They as a responsible government, they would have had to have been working on Plan B.
Yeah. Well, you'd hope, wouldn't you? I mean, yeah, because they really need it.
I mean, with Plan B, you're talking about the return of the drachma.
Yes.
Well, I mean, they are talking about a parallel currency, I understand. What's how does that work?
Yeah, I haven't followed that too closely because, personally, I do think they will stay in the euro. I think they just won't let Greece leave. I think they will they've tested them. The Greek public have spoken, so now it gives them a lot more negotiating power, and they will probably just restructure the debt.
Yeah.
They won't want contagion to occur. They have been defaulting for many years now, so it's not new as such. It's just come to a pivotal point now.
Mind you, the Germans and the French and the like were very willing before the GFC to lend large sums of money to the Greeks, so they're kind of authors of their own misfortune, are they not?
Yeah, of course. And Germany are making a fortune right now in terms of an economy with a weaker euro. The euro has been tremendously weak,
hasn't it?
They are really the powerhouse of the Eurozone, but they have had to prop up many countries. And it certainly will be interesting this week. And it's huge volatility in the markets at the moment.
Yeah, and that's where investors thrive, isn't it, with volatility?
They do. Over the weekend, we did see a lot of risks come off the table. This morning, we have seen a lot of flight to the US dollar as a key sign of safety and strength in the world economy.
Well, that begs the next question. What sort of, I know this is crystal ball territory, but what do you see happening to the cross rate between the US dollar and the euro?
Well, we've got the rate hikes that have been coming up in September, and obviously when the rate hikes happen, that's going to put more strength in the US dollar. And then a lot of commentators, I've been talking about it for a couple of weeks now, they said if there is a no vote, then that's going to put a lot more pressure on the euro and the US, and especially with the rate hikes as well. If they both happen, then we might even be seeing parity by the end of the year.
Yeah, every bank I read forecasts the euro to go to parity against the US dollar. They've been saying that for the last year now. It's great for the European nations in terms of export dollars. They will recover a lot faster with a weaker currency. And as the Fed look to raise rates potentially in September, this week we'll get the Fed minutes. They may use the Greek crisis and this as another reason to delay because they don't want the US dollar to strengthen too quickly, and you've started to hear Fed officials talk about that in the media.
But and the IMF also came out and said you need to wait till 2016 a couple of weeks ago.
Yeah, personally I think they do need to raise rates. It's crazy how long rates have stayed low. We've got the liquidity bubble going on with too much cash around the world, and
so all this quantitative easing, you got it in Japan, you got it in Europe. It's just so much cash, so much stimulus, and then you got China, which we'll talk about soon as well. That just throwing money out.
Let's just shift our focus closer to home. What's the latest with the Kiwi dollar versus the Aussie?
Against the Aussie, we're sitting around 88 cents. We've come off tremendously since we talked about parity not so long ago.
Dived, didn't it?
Against the US, we're 11th week in a row the Kiwi dollar was lower. We're now off 22 cents since the high of last year around September, around 88 cents. This morning we broke lower again to 66.50. A lot of forecasts are towards the 65 cent level. We have run very fast. A lot of negative news on the New Zealand economy. We had the dairy auction last week, which was a real shocking result. And now
consumer confidence, dairy, farming confidence, it's all going down. In fact, I wrote about it in print not last week, the week before, how we're just looking at a softer economy now, and that's going to force the Reserve Bank's hand. And in fact, your colleague was telling me, Sheldon, that we're going to see a couple more interest rate cuts by the end of the year.
Yeah, so all banks, most of the major banks and Deutsche and a few of them have been calling 3 rate cuts now.
3 rate cuts now.
And we saw that last week. ANZ were very bearish, and Westpac as well has come out, and it's putting a lot of pressure on Graham Wheeler, certainly with house prices being where they are. July 23rd is the next meeting. Market is pricing in 100% rate cut almost.
100%.
Well, I think it was 95%
That's
last
insane.
week.
Yeah.
Most of the banks have been calling it quite well and putting a lot of pressure on the RBNZ. I think it's Glenn Stevens from the RBA that has really almost forced the hand a bit. Inflation, the readings have been at record lows. We know there is inflation, but the recovery in oil may have a bigger effect there eventually.
And the other thing about this is, it's sort of similar with the euro and the dollar, and with the New Zealand and the US dollar as well. We've got an easing bias, while the US have got a tightening bias. And when you get to sort of levels like you were mentioning before, pushing down to 65, when we get to that lower 60 level, we might even push below, like coming up to 59. And there's a sort of psychological sort of thing that comes into effect at that part A. Yeah.
I mean, a lot of it's to do with US dollar strength. We have to remember that side of the equation. But as soon as Graham Wheeler changed his thinking and rhetoric in April, we've seen a massive unwind in the New Zealand dollar. Against the pound, we're off 15% in 3 months.
Yeah, I saw that. We're verging way lower.
So, interesting times.
Now, last week, the People's Bank of China added even more stimulus into the Chinese economy. In light of this, and with the indication more cuts from the central bank are coming, what's the outlook for the Kiwi against the yuan?
Well, that was something that I found very interesting as well. In fact, I talked about it on macroeconomic roundup last week, was that we had this week of huge news around Greece, and then sort of the Chinese stimulus kind of slipped under the radar a little bit from the mainstream headlines. But we saw a reduction of interest rates, a reduction of the reserve requirement ratio, which is, of course, how much money that banks are required to have, and just in another effort to see China just add more stimulus into their slowing economy.
I mean, the China story is it's fascinating to watch and look at the charts and see the unwind. We saw the Chinese market off almost 7% last week, 13% the prior week, 9% the week before that. We saw over the weekend, we saw brokerage houses in China confirm they're going to start buying more equities. They've put a hold on IPOs to allow more funds to go back into the existing stock market holdings. We saw a special meeting between the government. They're looking at short-selling bans. They're doing whatever they can to try and not have an absolute crash in their market, which has run so hard. It's run over 100% in the last year.
Because they've got kind of a problem, haven't they? Because they want to, the bank wants to, they don't want a bear market, but at the same time, they want to have more stimulus into the economy to kind of give it a bit more oomph, if you will. So it's almost a catch-22. So when what's your...
I mean, they're trying to stop manipulation of the stock market, but effectively some of the measures they're taking, you could argue they're trying to manipulate their market to stay higher. And I mean, the thing about the Chinese market is it's very closed in terms of they don't have huge foreign holdings. A lot of the people in China, and they're very much in their own market. Same as the property part. A lot of novice investors have now entered the Chinese stock market, which is a huge concern for this rally. A lot of them have not seen a huge bear market in the Chinese stocks. It's huge amount of IPO activity, huge frenzy within the Chinese market. And just some perspective, I mean, I think I read there was 20 cities in China that have bigger GDP than Greece. So it's a much bigger...
What's that say?
It's a much bigger story in the background that could affect New Zealand and especially Australia.
Now, gentlemen, let's take a quick look at the week ahead, and briefly, what's on the calendar?
Well, you got the RBA minutes, the RBA meeting this week. What's your opinion? Do you think on hold?
Yeah, I think he will certainly stay on hold. The market's pricing RBA staying on the sidelines. A lot of concern with housing continues. He won't be able to move. He's already moved Glenn Stevens 50 basis points. I think he will let that filter through to the economy and monitor the situation.
Because that's what they said in their last statement. We need to wait for it to filter through before we can see if it's had any effect.
Yeah, and the Australian dollar has depreciated. We have seen it this morning, 74 cents against the US. So they were up around, at one time they were 108 against the US. So it's come down tremendously, but the non-mining sector really has to see a pickup because the mining sector we know is slowing.
China don't want any more.
Iron ore prices continue to be forecast lower for the next 2 years. It's going to have a massive impact on their terms of trade. So the RBA minutes, the Fed minutes this week also, jobs numbers in Australia on Friday, and Janet Yellen will end the week with a speech early Saturday morning our time.
Interesting to hear what she has to say about Greece. Okay, look, thanks very much for that, gentlemen.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the Hanover settlement, Hanover Finance former shareholder Eric Watson isn't contributing to the $18 million settlement reached between the FMA and directors and promoters of the group just 2 weeks before a civil claim was due to be heard in court. His name is omitted from the settlement agreement, which lists contributions from the other 5 directors and promoters, Mark Hodgson, Sir Tiffany O'Regan, Greg Muir, Bruce Gordon and Dennis Broit. The FMA confirmed the negotiations had included insurers who provided the directors indemnity insurance, but wouldn't detail how much of the $18 million settlement came from insurance payouts. Mr Watson, who was not a director of any of the 3 companies, Hanover Finance Limited, Hanover Capital Limited and United Finance Limited, and therefore would have been unable to claim on insurance. He has also refused to admit he was a promoter of the company as claimed by the FMA. The money will be distributed to eligible investors who invested in the 3 companies in the period from December 7, 2007 to July 23, 2008. Of the 16,500 investors of all 3 companies, it's estimated only 5,500 will be eligible for a payout, and the sums involved also vary. It's thought Hanover Finance deposit holders will get between 14 and 17 cents in the dollar, while United Finance secured stockholders will get 16 to 20, and Hanover Capital bond holders will get between 5 and 7 cents in the dollar. The FMA has hired Deloitte to work out distributions on a pro rata basis, and the first payment is expected to be made in October. The original action filed in 2012 by the FMA was a civil claim for $35 million, and alleged misleading and untrue statements were made in prospectuses and advertisements distributed by Hanover between December 2007 and July 2008 about the financial position of the companies in that period. The defendants, who continue to deny liability and dispute the FMA's claims, are expected to release a media statement shortly. Mr Muir, who was about to board a plane in the US, said, "We're putting out a statement later in the piece and I'll leave it at that." FMA enforcement head Belinda Moffat said the FMA had investigated events before and after the period involved in the civil claim, including the latter moratorium Hanover Capital investors agreed to in 2008, but thought the period of December 2007 to July 2008 provided the strongest evidence to take a case to court. Hanover Finance froze $500 million of investor funds in July 2008 after running into financial difficulties, and investors eventually voted to accept a debt-for-equity deal with Allied Farmers, which later turned sour. The SFO conducted a lengthy investigation into Hanover and its related companies, but didn't lay any criminal charges. FMA Chief Executive Rob Everett said the decision to reach a settlement was carefully considered within the FMA, and it was felt the settlement provided a better and earlier outcome for investors, rather than going to court, where the outcome was uncertain and the costs of taking the case could have eaten into the sum investors would have ended up with. The FMA said the investigations into Hanover, including taking asset preservation orders against Mark Hodgson, had cost $3.5 million and a further 10,000 hours of the market watchdog staff time. Let's talk Global Mode, not here but over there. The company that created the controversial Global Mode technology has rebounded from its recent legal setback by signing a deal with an Australian ISP. Bypass Network Services Limited, or BNSL, Commercial Director Matthew Jackson told NBR that a new internet service provider, YourNet, due to launch across the Tasman in August, has licensed Global Mode and will offer it to all its customers. Global Mode allows every customer of an ISP to access overseas services that are usually geo-blocked, such as the US version of Netflix, BBC iPlayer, Hulu and Amazon Prime. Unlike software add-ons, you don't need any level of technical nous. BNSL is also lining up a deal with an Indonesian partner. Today, Mr. Jackson added the nuance that the service offered via Indonesian cloud will be tailored to the local market, where strict censorship laws prohibit violent scenes plus sex scenes as mild as kissing. BNSL is well equipped to deal with such filtering requirements, given it has a cyber safety product called Bodyguard in development. There's no doubt BNSL took a major revenue hit when the Global Mode case was settled before a High Court trial. BNSL and its major client Call Plus, which has 220,000 customers across its Slingshot, Orcon and Flip brands, agreed to drop Global Mode in New Zealand. In return, Sky TV, TVNZ, MediaWorks and Lightbox owner Spark agreed to drop legal action. But when Call Plus accounted for most of BNSL's revenue ahead of the settlement, Mr. Jackson says the future of our business is in Europe. The European Union's move to eliminate geo-blocking has created a major business opportunity for his company, and it's fielding multiple inquiries from EU countries. Mr. Jackson says BNSL has interest from ISPs in multiple EU countries. NBR understands from an April 13 interview that at least one New Zealand government agency is assisting BNSL with its offshore push. The company is also in talks with several ISPs over its Bodyguard service. Mr. Jackson says, like Global Mode, Bodyguard covers all customers who belong to an ISP. The filtering software will provide options for parents worried about which sites their children can access.
NBR Radio, Monday the 6th. I'm John Stewart. Consumers are rejecting the notion GST should be slapped on online goods and say local retailers should simply become more competitive. I'm joined by reporter Campbell Gibson, who's been looking at the survey which has produced this information. Campbell, where have the findings come from?
They've come from Horizon Research, which did a poll of about just under 1,500 people, 1,500 adults. And I'm sure many of our readers, or listeners rather, are aware that GST is only applied to goods that are imported from overseas if they're worth more than $400 or if they attract a duty of more than $60. And I suppose some of the findings are sort of non-surprising, actually. If you're asked, do you want more tax to be put on the goods you buy from overseas, of course you're going to say no. So about 50% of those involved in the poll said, no, I don't want any more GST paid on goods worth more than $400, and only 21% supported the notion that GST should be applied. And when you hear, even after they heard the argument that the status quo could result in job losses and shops being closed, that still didn't seem to faze too many of them. Only 43% said businesses should just simply become more competitive, and that's price competitive. And only 32% said that goods should receive taxes. So even, when they're made aware of the fact that this is sort of harming a few retailers, they don't seem to be bothered too much.
So what's been the reaction from local retailers here?
Well, I spoke to Retail New Zealand's spokesman, Greg Hartford, and he said it sort of indicates that New Zealanders aren't really sort of aware of the effects that this is having on retailers. He says town centres are becoming weaker and retailers are having to close shop. And he says, they're working hard to make sure that they can deliver the best service, but the reality is that it's a sort of uneven playing field. And on the other hand, you've got New Zealand Initiative Research Head Eric Crampton saying that if you did apply these GST rules to overseas goods, it would simply sort of stunt online growth, online purchases growth, which has been growing quite significantly over the past few years.
Now, our online buying is increasing, but is that money going to local retailers or overseas?
It's mainly going to domestic retailers at this point, but that gap is closing pretty quickly. It used to be quite a different story about 4 years ago in 2011, but over the past few years that gap's gotten closer. So 59% of our $2.9 billion online purchases market goes towards domestic retailers, but if you have a look at BNZ's online retail stats for May, you'll see that domestic purchases were up only about 3%, but overseas purchases were up 23%, and there was a sort of a slump compared to last year, but still the gap, like I said, is closing in quite quickly.
Indeed. Thanks very much for that, Campbell.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
NBR Radio, Monday the 6th. I'm John Stewart. And I'm joined by our political editor, Rob Hosking, in Wellington to take a look at the week ahead. Now, Rob, I think your first topic is the NZIER quarterly survey on the local business mood. What are you expecting there?
Yeah, this comes out tomorrow morning, and they do it every 3 months. They survey roughly a couple of thousand businesses, and it's a fairly significant pointer to where the economy is heading, or where it's probably going to head. It's not as accurate as it used to be because none of these indicators are as accurate as they used to be. One thing that's happened since the global financial crisis is things are a lot more the sort of forward-looking data is a lot more spongy, if I can put it that way.
Right.
But it's it's not just are you optimistic, are you pessimistic? It goes into what sort of plans do you have for your own business? Are you planning to hire in the next 3 months? Are you planning to invest more? What are you planning to do with your prices? What are you expecting your costs to do? And the other interesting thing it does, or the crucial thing it does, is it also asks them not just about the next 3 months, it asks them about what your experience of the previous 3 months was. So, a firm that, so you can see if it panned out, if you see what I mean, because you then get a 3-monthly update in a quarter's time. And look, the last few surveys have shown business investment running at levels last seen in more than 20 years ago. You've got to go back to 1994 when we were coming out of that very, very, very long recession in the early 90s. And so, look, I would be astonished if they don't come back this time. There'll probably be a pullback in hiring intentions as well. Overall optimism for the economy, that often gets a lot of the attention, but it's probably less important than what firms expect for their own business. That's going to be the crucial one. And if this pulls back significantly, then I think for one thing you'll see the dollar take yet another tumble, and you'll have to have a look at the policymakers, and by the policymakers here I mean not only the Reserve Bank but also the government, looking at maybe shifting their view of the economic outlook somewhat. This survey doesn't cover farmers. It of course covers industries which do supply farmers, but it doesn't cover farmers themselves. Right. So if this takes a significant tumble, this is not directly affected by the dairy price. If this takes a significant tumble, then I think we're probably looking at a reasonably sizable, not recession, certainly nothing like that, but we're looking at economic growth coming off. Those expectations, those forecasts, which were around 3%, we're looking at quite a bit lower than that, I suspect.
Now, let's shift our gaze to the political arena and some interesting developments with the deputy leadership of New Zealand First. What's behind all that, Rob, now that we've got Ron Mark as displaced Tracy Martin, isn't it?
Yeah, this was one of the more bizarre leadership role changes that I've ever seen, because they did it on Tuesday and refused to tell anyone until Friday. And Parliament, being the sort of place it is, the rumour went into some sort of centrifugal meltdown in the ensuing 3 days. But it was very firmly no comment. We'll tell you later. It's sort of, what if you held a deputy leadership change and didn't tell anyone? It was almost a Zen approach to politics. If a deputy leadership change happens and nobody tells anyone, does it actually happen? A tree falls in the forest, that sort of thing. It was very, very strange. What seems to be behind it is at least sort of from an anecdotal point of view, is it has long been rumoured that Winston Peters would stand aside at some point in the next, if not by the end of this term, then in the next term, and former Labour MP Shane Jones will be parachuted in and take over the NZ First leadership. And Ron Mark is not an unambitious chap. He was an MP for a number of years. He lost his seat. He was a list MP. He lost his seat in 2008 when New Zealand First got voted out of Parliament. He came back in last time, and in the interim, of course, he became Mayor of Carterton, so he can sort of get elected to positions like that outside Parliament. So he came in with a bit of a headwind, with a bit of a tailwind behind him, political tailwind. And he has a certain public profile. I don't think anybody outside the political sort of junkies would have known who the deputy leader was before last week. Tracy Martin has a lot of support within the party, but obviously not enough in caucus, but, she has her profile outside is just nil. The problem with the scenario that, they bring Shane Jones in and take over, assumes that would actually work.
And it assumes also that Jones would be interested.
Well, that's another big assumption, and I've personally always sort of doubted that would ever actually happen, even if he has expressed an interest, and of course he's not saying.
He's probably quite happy in this ambassadorial kind of position he's got at the moment.
Well, I would have thought so. I mean, it's a well-paid one. It's not it's out of the public eye to some degree. He can sort of do his thing there. Whereas bringing someone in to take over a political party they're not even a member of, is fine so long as you don't think the members of that political party are going to have a say on it. But of course, we're talking about politicians here.
Yeah.
And of course, they're going to be very, very upset about this. So the whole sort of scenario that they just bring Shane Jones in and the rest of the New Zealand First Caucus would just meekly trot along with this.
So you've got to take egos into account, really, don't you?
Well, yeah, egos and personal pride and all the rest of it. It just always seemed to me to be a completely daft idea. And this seems to be a move to forestall that. And Ron Mark, when he came back in, it was quite noticeable. He was well down on the party list at the last election. He was ranked at number 9, which if New Zealand First's vote had stayed roughly where it was at the previous election, he would not have come back in.
Now, let's just shift on to what else is happening this week. I think there's some sort of review of the EQC, the Earthquake Commission.
Yeah, this has been coming for a long time. It's obviously flows on from the Canterbury earthquakes. It's about changing slightly how the commission is funded and what it covers. It's not going to cover, and look, these are proposals. And the government is asking for submissions on it. But what's proposed is, firstly, the first 100,000 coverage of your house was covered by the EQC. Now, that amount was set in 1992 when the current legislation was passed. And we all know what's happened to house values since then. So they're lifting that threshold up to 200,000. Secondly, it's taking contents out, so they won't cover contents. You've got this sort of slightly bizarre situation at the moment where if you slam the example Brownlee gave today was if you slam a door and something valuable falls off a shelf, it's not covered by EQC. If your house rattles for an earthquake, it is covered by EQC. And so it's not a huge. The financial value of that cover is not huge in the overall scheme of things anyway. So basically they're saying, look, that sort of thing, you've covered yourself.
Yeah.
The more important thing from a sort of structural point of view is building up the buffers of building up that natural disaster fund to cover future natural disasters. Now, they had coverage of around $8 billion when the earthquakes hit, or a little bit under that. That was estimated as being, at the time, good enough for covering one natural disaster, but not two. And of course, the cupboard's bare now. So this is about lifting that fund back up again gradually. It will take 20 to 30 years to do that. Of course, even if another big one hit, well, the government underwrites the whole lot, right? So you and me as taxpayers, we cover all this. So, but it's about building that fund back up and having that reserve there, so it's there to basically smooth the costs and help future governments who have to deal with natural disasters like the one that hit Canterbury.
Yeah, indeed. Now, just the ongoing debate about housing and what the government claims is not a housing crisis, if I understand you correctly. What developments are we likely to see there this week?
Look, I'm not expecting anything hugely specific. I'm just, this is just an ongoing running sore now. And I saw some research this morning from one of the banks that sort of looked at what's happening to construction levels, and we know that construction has picked up considerably, but it in no way comes anywhere near affecting or reaching the increase in demand from population growth. The gap there is just phenomenal. You look at the graph for net inwards immigration, and don't forget more than half that inwards migration goes to Auckland, and it's running up at a sort of 60-degree angle. And then you look at what's happening to housing construction, and it's not even at replacement values, even if immigration was flat. And that's the issue we've got. And really, tweaking rules around LVRs and tax and all the rest of it ain't going to do this. And this is going to get worse before it gets better.
Yeah. Okay, let's wrap it up there, Rob, and thanks very much for your views on the week ahead.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Let's talk stolen cars. Japanese cars have proved to be popular among thieves, as the AA's list of the top 10 most stolen cars in New Zealand are all Japanese. The Honda Tornio has raced ahead to the top spot for the fourth consecutive year. AA Customer Relations Manager Amelia McAndrew says although the probability of the Honda Torneos being stolen is far higher than any other car AA insures, there are no more of them on the road than any other vehicle. So here is the top 10 list based on AA Insurance's data, starting with number 10. Number 10, Mazda Premacy. Number 9, Mazda Atenza. Number 8, Nissan Stagea. 7, Subaru Forester. 6, Honda Integra. 5, Nissan Safari. 4, Mitsubishi Libero. 3, a Subaru Impreza. Number 2, Mazda Familia. And number 1, yes, that Honda Tornio. The data reveals 92% of the theft claims for models in the top 10 list were for cars manufactured more than 10 years ago, with the average value of a stolen vehicle claim from the top 10 list $5,120. Ms. McAndrew says thieves will also go for the easiest, fastest option. Despite vehicle theft remaining a concern, the figures have been relatively consistent over the past 3 years. New Zealand Police crime stats say there were 49,121 motor vehicle thefts and related offences in 2014, compared with 48,375 in 2013 and almost 50,000 in 2012. Ms. McAndrew says to prevent theft, simple actions are most effective, such as locking the car, even when it's at home or parked in the garage. She says while it's up to you to take all reasonable steps to ensure the safety and security of your car, if you've mistakenly forgot to lock it, you'll generally still be covered by your insurance. Let's talk tenure review. A land tenure proposal for Mount Creighton Station near Queenstown could provide its overseas owners with windfall profits. The owners include wealthy US investors who have obtained permission from the OIO to buy the freeholded property for a price to be determined by the final outcome of the tenure review negotiations. The proposal would return the pastoral lease over 10,337 hectares to Crown ownership. This would leave the owners of the property with 5,342 hectares of freehold land, according to documents on the Land Information New Zealand website. Tenure review is when leaseholders of high country stations surrender ecologically sensitive land in return for freehold land, sometimes including cash payments to the Crown or vice versa, depending on the individual deal. Lincoln lecturer Anne Brower says based on some other lifestyle and sales after tenure review, the owners could make windfall profits from on-selling the freeholded land. She presented her latest controversial research on Crown lease tenure review at the New Zealand Association of Economists Conference in Wellington last week, where she said that some freeholded land had sold at several hundred times its previous value when subdivided, especially if it had amenity values like views over lakes. The inference from her research is the Crown, via its agency Land Information New Zealand, is only taking pastoral values into account during tenure review and therefore shortchanging taxpayers. Shareholders in Mount Creighton Station as trustee for Mount Creighton Joint Venture include Steve Fisher, who lives in Herne Bay in Auckland, Henry Harvey of Connecticut, Bill Lipner of Connecticut, Arthur Patterson of San Francisco, Craig Roberts of Greenwich in the US, and Arrowtown-based Bill Shaw, a New Zealand investor with a history in ownership and management of luxury lodge properties. The LINZ negotiated proposal includes several environmental covenants and easements. According to a resource consent issued by Queenstown Lakes District Council in October 2014, the shareholders have plans for a huge 644 square metre ranch-style campus with a total footprint, including courtyards, of 958 square metres on an elevated site on Mount Creighton Station overlooking Lake Wakatupu near Glenorchy. The 6 families in the Mount Creighton joint venture want to have their own residence to stay when they're visiting, the resource consent report says. Baxter Associates of Queenstown has been working for the Mount Creighton shareholders. To the forestry sector, forestry leaders have lashed out at the government grasp of the industry following comments by Primary Industries Associate Minister Joe Goodhue. Last month, the president of the New Zealand Forestry Institute, James Treadwell, said the national government does not take forestry seriously. In a hard-hitting attack on NBR Online, Mr Treadwell said government policy effectively discriminates against forestry, while policy reform is being kicked to touch by politicians who have the weakest grasp on industry issues. Ms Goodhue responded on Friday by rebutting Mr Treadwell's remarks without addressing the key points raised by Mr Treadwell, saying his comments not only denounce the work of the ministry, but also discount the work of his sector colleagues. However, his sector colleagues beg to differ. Andrew Caddy, a former forester turned solicitor working closely with the forestry sector, says what James is saying is totally correct. He said, "I do not believe the government takes forestry seriously." By way of example, the Associate Minister's press effectively says in her right of reply how much she loves the industry and understands we are the third biggest export earner to the value of $4.5 billion. Well, in actual fact, last year the industry did over $5.1 billion. Mr. Caddy says such an error is typical of the government's lack of interest in the sector. He adds that he believes government policy effectively discriminates against the forestry sector, much as Mr. Treadwell had noted. Bob Hocknell, a registered member of the New Zealand Institute of Forestry who's worked in the industry in a management role for 49 years, says this government does not appear to take the forestry industry seriously. Mr. Pockner, who's also a councillor of the New Zealand Institute of Forestry, says National has not done enough for the forestry industry. There is no level playing field for business support in the rural sector, no cognizance of the environmental benefits that forestry brings to sustainable land management, just a weak government department that is under-resourced and underfunded to support the needs of the sector. For more on this, nbr.co.nz.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Monday the 6th. I'm John Stewart. Greeks have voted a resounding no in the referendum held at the weekend on debt bailout crisis. In his editor's insight today, Neville Gibson says the no vote can only mean more tragedy for the Greek people. Neville, the vote must represent the will of the people, nearly two-thirds of them. Why would they want this crisis to get worse?
Well, they had a majority of 61%. That's nearly 2 out of every 3 Greeks are backing what is, by anyone's description, an extreme left-wing government. And it hopes that it can come up with something better than the measures that are being proposed by the lenders, who are led by Germany. When Greece entered the Eurozone back in 2001, the then government, of course, was saying that their future prosperity would be guaranteed by joining what is still the world's largest economic grouping. But that dream's now turned to ashes, and I think it can only get worse before it gets better, because if they had said yes, there would definitely have been an imposition of some austerity and reforms, and there would have been the bailout of the banking system, which is really the focus here, would have continued. But instead, the Prime Minister, Alexis Tsipras, says we want fairness. He's got all those left-wing slogans, and he thinks that by going to the people, he's got the moral backing of most Greeks to go back and renegotiate to lenders who've already given them some 323 billion euros. That's well over 500 billion New Zealand dollars, and they've defaulted on a loan to the IMF. This is almost unheard of among developed countries just last week. So I don't give him much of a chance of getting what he wants.
Now, of course, this all results from a lot of money pouring into Greece in the last decade or so from these very lenders who are now demanding austerity.
Well, what I've just said is pretty well known to everyone, but what I've focused on in today's insight is the impact on the Greek people themselves and how they might have got into this plight. And one of the interesting things is that when they joined the Eurozone back in 2001, Greeks had a pretty low level of borrowing. I suspect they, like a lot of people, are a bit suspicious of banks, and they're famous, of course, for keeping their money under the mattress, so the tax authorities couldn't get at it. In fact, the borrowing by Greeks was around about 24 billion euros. That's not big. But today, or by 2009, this had nearly tripled, and today it's well over 100 billion, and it's mainly in mortgages. And of course, in the first quarter of this year, that's to the end of April, there's 4 big banks in Greece that lend on mortgages, and they say between 32 and 39%, that's round about a third of these loans are not being repaid. And obviously that's since accelerated in the past few weeks as the crisis has come to its peak, and you've got an unemployment prospect of foreclosures is quite realistic. It's the kind of downward spiral that people can't pay back their mortgages, they lose their jobs, things get worse. It's the kind of spiral that even the Reserve Bank of New Zealand is worried about when you come to wondering why are they worried about the financial system and Auckland house prices.
The Greek government is now trying to get another round of negotiations with those lenders, the IMF, the ECB and so on. What's the likely result of that?
Well, you've got a group of establishment financiers and finance ministers across the EU who are not very happy with a radical socialist approach. Really, the Prime Minister in Greece has been playing a kind of brinkmanship, just seeing how far he can push them, hoping that they'll cave in. There seem to be no indications at the moment that either the ECB, which is the main lender underwriting the banking system of world, which is just about to run out of money, and its rules say it can't lend to any insolvent banks. So it's going to have a close look at these major banks in Greece and the situation regarding the mortgages before they do anything. I think Greece really has only a couple of options to fall back on if the solution goes back to them and the lenders say, well, OK, you do your worst, you don't want to pay us back, we're not going to give you a bailout. They could do what happened in Cyprus, where the government just seizes most of the bank deposits that already exist. They're already locked up, the banks are closed, so there's money there and use that, and then that's called a bail-in, and then they sort of say, right, we're going to leave the Eurozone, we're going to dump the euro, we're going to go back to the drachma, and we'll recapitalise all the banks using their own currency. Now, that might be a left-wing dream. There's also quite a few right-wingers who would like to see it happen. I see this morning Prime Minister John Key even said at least this would give them a clean start, and that's correct because a number of countries have done this in the past and done quite well. In other words, they just let the whole system collapse, tell the borrowers, tough, we're not going to pay you back, and then start all over again.
So in that view expressed by the Prime Minister, what are the chances of it happening?
Well, I think the lenders will protect themselves pretty well. They won't get the money back, but apart from those who have invested in Greek bonds in the private sector, and it's a bit unsure as to just how many of those mortgages might be in the private system as opposed to the huge debt, which is mainly owed by the Greeks to the governments because they've bailed out most of the EU, bailed out most of the banks there. So the losses are going to be on governments, and maybe they just have to lump it in the meantime. Where this has occurred before, you've got now a middle class in Greece who all voted, I imagine, yes. They're going to be impoverished by devaluation, no question about that. The only places where this has occurred have been usually in South America, Chile, Venezuela, these sort of countries, and they really get going. If you think the working class are pretty rebellious, when the middle classes get going, as they have done in South America, you get a change of government.
Now, if Greece leaves the Eurozone, could we get contagion? I mean, are others likely to follow?
This is a question that's always raised as to that this could be a possibility, but I don't think there is certainly anti-EU or not Eurozone, but anti-EU parties around. In Spain there's a big one called Podemos, which is a left-wing one. Most of the countries have got right-wing ones that are we call them Eurosceptic parties, but they're more worried about the role of the EU and letting in a whole lot of illegal immigrants from the Middle East and Africa, not about the financial system. And I think if there is an implosion, as I've outlined, in the banking system in Greece, all these other people who live in Portugal and Italy and so on, they'll say, here, we don't want to. We might be opposed to the Brussels and the EU, but we're not going to go and lose all our money. So I don't think there's going to be contagion in that sense. And certainly a lot of those majority populations in the rest of the EU that don't think the Greeks should get a free ride in any case. So I think the lenders will hang on. They'll see what happens and let the Greeks be roasted a little bit more, see how far they can keep their feet in the fire.
Indeed. Thanks very much, Neville, for today's Editor's Insight.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
I'm Grant Walker with the last call. Here's what's trending on NBR Online. Big changes to EQC, payouts possible. We look at the Hanover settlement, what all the parties had to say about it and who didn't pay. Motel chain sues Westpac over those share swaps. Global Mode Service goes Global. And a call for retailers to be more competitive. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. Back to Greece. Greece's Prime Minister Alexis Tsipras says getting the financial system working again will be his top priority. Greeks have voted by 61% to 39% to reject bailout terms demanded by international creditors. The banks have been closed for a week with restrictions on cash withdrawals and controls on capital movements. Mr Tsipras and his left-wing government campaigned for a no vote to conditions by Eurozone lenders for additional loans to underwrite Greece's banking system. Mr Tsipras said in a televised speech after the votes were counted, "I am fully aware that the order that I was given is not for a rupture with Europe, but a mandate boosting our negotiating strength to reach a sustainable deal. We all know that there are no easy solutions, but there are fair solutions, there are sustainable solutions. As of tomorrow, Monday, Greece will sit at the negotiating table. Our immediate priority is to restore the operations of banks and economic stability. Today we celebrate the winning of democracy. As of tomorrow, altogether, we must continue and complete the national effort to reach a deal." Meanwhile, the ramifications of Greek opposition to paying its debts are being felt in financial markets. The euro has dropped to around $1.10 and 133.7 yen in currency trading on Asian markets. This is likely to lead to a further sell-off in euro shares when trading resumes tonight New Zealand time. Eurozone finance ministers are unlikely to offer concessions that involve debt write-offs, and it's unknown whether the European Central Bank will continue to support Greek banks' liquidity. German Vice-Chancellor Sigmar Gabriel has said in an interview published today that he doubts a further bailout can be agreed. He says Mr Tsipras has destroyed the last bridges across which Europe and Greece could have moved towards a compromise. Mr Gabriel says by rejecting the rules of the Eurozone, negotiations over multi-billion-dollar aid programs are difficult to picture. Tsipras and his government are leading the Greek people onto a path of bitter sacrifice and hopelessness. Overseas, and a Swiss businessman claiming to be ambassador and Treasury Minister plenipotentiary of the Kingdom of Maori has complained to newsletter Offshore Alert about its inquiries into an alleged investment scam. In a letter published on Offshore Alert's website, Jean-Philippe Grange of Newport Enterprises Group LLC requested an apology from editor David Marchant for asking questions about his firm's apparent connection to UK forex broker CWM. He wrote, "Your inquiry is illegal and will be reported to OFAC, who will make a robust response to ensure that your illegal actions and policies are stopped." Mr Grange and Newport Enterprises Group was a shareholder of CWM Holding LLC and a creditor to CWM BVI Limited, as our FATCA Bank mandate was violated in that the fees were not paid. His letter described Newport as a US Treasury International Securities Custodian Bank and said he was Treasury Minister, Plenipotentiary and Ambassador USA, Te Tau Sovereignty and Kingdom of Maori. Contacted by NBR about his Maori title, Mr Grange directed inquiries to Neil Lister, a New Zealander living in Las Vegas. Mr Lister said the title was awarded by King George Watene Tautari, an Aucklander, because Mr Grange said he would help recover Maori money derived from an agreement with Britain's King George III but subsequently dispersed. Mr Lister, who said he was working in the US as Mr Tautari's Attorney General, said they have the right to investigate stolen monies. George found out that a lot of his relations are Cherokee Maori, so I've been signing up treaties with them while I've been travelling. He said no money had changed hands between Mr Tautari and Mr Grange. Mr Marchant's inquiry to Newport followed receipt of a letter dated June 19 to CWM introducers from Newport saying client money remained with the bank accounts of prime brokers. It said, while our due diligence is not yet complete, to date we have not seen any evidence of wrongdoing with clients' funds. All things being equal, we hope to have a viable financial solution within 1 month and further bulletins will be forthcoming. In March, City of London police arrested 13 staff of forex company CWM, also known as Capital World Markets, on suspicion of conspiracy to defraud and money laundering. The 10 men and 3 women were questioned and released on bail. Detective Superintendent Maria Woodall, who's overseeing the investigation for the City of London Police, asked anyone who may have invested in CWM to contact police. The primary objective of the arrest phase of this investigation, she said, was to stop what we believe was ongoing criminality and prevent people putting their money into CWM's managed funds, offering 5% interest per month. In May, Britain's Telegraph newspaper reported that Gurkhas, Nepalese soldiers in the British Army, had been investors in CWM. It quoted a statement from a spokesman for CWM Holdings LLC saying, CWM is privileged to be involved with the Nepalese and Gurkha communities. We believe that it's inappropriate that, as far as we are aware, the Gurkhas alone have been singled out as a group of investors for exploitation purely to garner media attention. Offers have been made to the police to ring-fence money additional to the sums invested in order to reassure investors. All the allegations are robustly denied. None of those arrested has been charged.
NBR Radio, Monday the 6th. I'm John Stewart. New Zealand's equity markets plummeted in June, performing worse than any other developed or emerging market, according to the Standard & Poor's Dow Jones indices. I'm joined by reporter Jason Walls. Jason, how does our performance compare with other markets?
Well, it was very interesting, this report, actually. I got it midway through last week, and I was snowed under with Greece stuff before I got to have an opportunity to actually look at it. And when I took a little bit of an in-depth look and an analysis of it, and you saw that New Zealand was actually at the bottom. So out of the 48 equity markets that S&P analysed, New Zealand was right at the bottom for the month of June. So we were down negative 7.45%. So it's quite a big and quite an alarming number, especially when you compare that to other people on the list. For example, we got Australia, who were only down 5.23%, and China, that was down 6.15%, and the US was only down about 2%. And in fact, probably the thing that caught my attention the most was that we were actually down further than Greece was, which was insane when you think about it. However, when I looked at it a little bit more, did a little bit more digging, I kind of got a little bit of an understanding about why New Zealand's equity market dipped so much. And it wasn't so much the local markets, because they only dipped about 2%. It was actually the international markets and things to do with currency, which had a huge effect. And the reason for that is you'll remember that we had the OCR cut on the 11th of June. And it was sort of quite 50-50 almost. I mean, some markets were pricing in, others weren't. Analysts were saying one thing, some were saying the other thing. So it was very much up in the air of what would happen. And we got not only just an OCR cut, but we got an indication that more would be coming. And that's the big thing for currency traders, because when they see this as a sort of a red flag to say that the interest rate is going to continue to decrease, that means their dollar is going to decrease as well. So we had a lot of capital investors and foreign investors exiting the market because they saw this.
Is that why analyst Grant Williamson says he's not surprised?
Yeah, that's exactly what he said. He said that this isn't the first time that this has happened. I mean, when you think about it analytically, it does make a little bit of sense because, as I was just outlining, people want to get the best return on their investment. And so if they see the dollar losing value, it makes sense for them to exit the market like that. But yeah, he was saying that this has happened before, and in recent times, foreign investors have been eyeing up the local market to see what they can do. And he did reiterate that it wasn't so much the local investors and some of the stocks and things like that had that much of an effect. But, I mean, that they were down as well, as he outlined, by about 2%.
Well, when we look at the potential spin-off from the Greek crisis, on spin-off in terms of share markets.
Yep.
Does this cloud have any silver lining for New Zealand?
Well, I wrote about it a little bit last week, and New Zealand had basically already weathered the storm. I mean, we've got to remember that markets have been pricing in what's happening in Greece for a long time, because it's just like this, although it's sort of hard to make sense of a lot of the time and a little bit uncertain, the one thing that we're all certain about is that the situation is very volatile. So markets have been pricing that in for a while. So New Zealand, and the same broker actually, Mr. Williamson, was telling me last week that we'd already weathered the storm. There are new developments with the Greeks saying no, but as we heard on Currency Talk this morning, CMC Markets' Chris Smith says that they're probably going to stay in the euro because they can't afford to leave the eurozone at this point. So, I mean, I don't want to look into my magic crystal ball here, but I think we've already kind of weathered the storm. But we will see that markets are being hit and will continue to sort of lose a bit of pace because of what's happening in Europe.
Jason, thanks very much for that.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Monday the 6th. I'm John Stewart. Our NBR Readers poll shows the Sky Path on the Auckland Harbour Bridge should go ahead. there'll be a toll of what's expected to be between $2 and $4 each way. But will that be enough to make it self-sufficient without ratepayer support? I'm joined by Auckland Councillor Cameron Brewer and transport blogger and strong Skypath supporter Patrick Reynolds. Now, gentlemen, I'll begin with you, Cameron. Do you have your doubts that, in fact, this will be self-sustaining without ratepayer support?
Oh, well, first of all, congratulations to the team that's put this project together over 10 long, arduous years. It hasn't been an easy one. But I suppose what I'm looking for when the final business case comes to council, possibly as soon as September, John, is that it's not asking for a ratepayer underwrite based on very ambitious figures. In the past, we've seen patronage forecasts of cyclists and walkers of up to nearly $800,000 a year, and the suggestion is that if it falls below 75% of that, the ratepayers pick up the difference. So, look, I'll be supportive of the Skypath if it doesn't use the residential suburban ratepayer as the backstop if they don't quite get the numbers as forecast.
Do you think they stand a good chance of getting those numbers, though? There are enough keen walkers and cyclists?
Oh, well, look. I hope they do. But when you think of 781,000 off the last estimates done by one consultancy,
that's per year.
That's per year. That's 2,140 a day, and so in daylight hours, paid users. That's quite a steady flow of cyclists and walkers. ATED, Auckland Tourism Events and Economic Development, John, they've suggested that people from cruise ships might be, some of the visitors that use this. But we know that the average age of a cruise ship passenger coming into Auckland is reasonably old. I'm not saying they're unfit, but it's quite a big ask and quite a big disconnect, unlike the Sydney Harbour Bridge, from downtown Auckland around to the Harbour Bridge and up what is quite a steep gradient. So, look, I think a lot of people will go and try it out. Me and my young family will be some of those that try it out. But it's a case of, can they keep it up? The forecast suggests that they'll go from to $2 million per annum.
Patrick,
enter into this. This question is a very strange one because, Cameron, do you object to other cycle programs in the city?
No, not at all. We've got a great one going through, NZTA funded, going through
really?
Iraqi
this is the one through your ward,
in the next couple of years.
Is it? Right, well, of course, perhaps you really aren't facing the front because it is a $39 million project. $13 million of that is coming from your council. That is $13 million we're definitely spending on that. We're dropping on that. No one is paying to use it. It's free as the wind through your board. Yet you seem to be raising concerns about a PPP that in all likelihood will cost the council zero. It seems to me to be in a very, very strange objection. Why aren't you campaigning against that $13 million that ratepayers are paying for the free route through your ward?
Okay, no, that's fine. And that project's been put out there as an NZTA/Auckland Council project. Tick. And there's many projects that are funded 100% by council. My concern with this, Patrick, is that if it's going to be such a huge success, and I hope it is, and every Aucklander hopes it is, and 75% of NBR people that did the poll support it, but if it's going to be such a huge success, then you won't need to come, Infratel, the promoters, the well-oiled machine that it is, won't need to ask the poor old suburban ratepayer to be underwriter. Put your money where your mouth is.
The poor old suburban ratepayer is already out of pocket $13 million for a route through your ward. This is a theoretical possible cost in the future. So, your activism on this is misplaced. You're sort of white-handing your concern trolling about it. I find it very interesting that the residents, of course, on North Coast, the small number, the handful of residents who are objecting to it, their complaint is the reverse. They believe they're going to be swamped with people. I think the article in the NBR had that kind of ironic thing between two paragraphs. You saying no one will use it, then the residents saying millions will use it. The fact remains this should be funded in the normal way, shouldn't it? I mean, it really should be funded by our usual transport spend.
But
it won't be costing... this is the number one cycling project in the region, as identified by everyone, from Auckland Transport to NZTA to the government itself. the fact that they couldn't get the authorities to move on it led, enthusiastic people to, as you say, put 10 years of incredibly hard, selfless work into it to get it to happen. This is a great example of ground-up support. I'm just sort of exasperated that the possible cost to the ratepayers for the number one project in the city is being beaten up as an issue. There's nothing to see here, really.
That's a good point about the whole question of cost to the ratepayers, because we've got the Auckland plan with projected 9.9% increase in rates. One just wonders how the ratepayers will react if they are asked to subsidise the Skypath.
Well, hang on, John. But the ratepayer is already going to be down 13 million for that one example in.
Yeah, but that's a one-off.
The councillor's ward. So
that's fine. We're spending, Patrick. Can I just have a word here? We're spending $60 billion over the next 10 years on operational and capital funding projects. And I'm not necessarily against this project, nor am I out there saying it's doomed to fail. What I'm saying is that if it's going to be such a huge success, and you guys have done a lot of work around the numbers and the forecast, then the best chance of getting this through in September is to say, look, guys, we're so optimistic about this that we're not even requiring you guys to be underwriters. We're going to carry the risk as a private sector company, and we're confident that we'll make plenty of money off this and that we'll exceed forecasts. And then you'll get unanimous support around the council.
You've kind of got it backwards. You're presenting this as if there's a private company here that sees an opportunity to make money. This is actually a bunch of activists getting together to plug institutional failure to fund a necessary project. I really struggle to find a problem with this.
Well, then put your money where your mouth is.
Funding this itself, and you'd be certainly up for $30 million instead of possibly be up for $2 million sometime in the future. Also, fears about ridership, people turning up to use this. You have a great history of predicting that no one will ride a train, no one will use a bus. This constant prediction of doom. Yet this route is almost. If there was any route that was a dead ringer, it's this one, simply because obviously there's so little opportunity to use any other route.
Well, what sort of polls are there of potential users, by the way? Potential walkers and cyclists? POLLS, yeah. Have people been polled, commuters, as to whether they would avail themselves of the Skypath?
Oh, there's been all sorts of work on who will use it. The risk to everyone involved is tiny in the way this has been structured. I mean, there's much more risk in the Eastern Connection, where we're going to build it fully funded and then wait to see if anyone turns up. I mean, why is there more risk on this? Simply because there's a cost. Right.
Well, gentlemen, I think we'd better wrap it up there. I think you'll probably both agree to disagree.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
Let's talk retail. Consumers are rejecting the notion GST should be slapped on online goods and say local retailers should simply become more competitive. A survey of almost 1,500 adults by Horizon Researchers gauged people's reactions to Prime Minister John Key saying it was inevitable GST would be charged on goods imported from overseas. GST's only applied to imported goods worth more than $400 or attract a duty of $60 or more, and only loosely. Of those surveyed, only 21% support the argument taxes and duties on goods bought overseas should be the same as those bought in New Zealand. The majority, 50.1%, believe that no taxes or duties should be paid on goods with a value of $400 or more or attracts a duty of $60 or more. After hearing the argument that the status quo would close shops and cost jobs, 32.1% wanted equal tax treatment, but 43.6% said New Zealand businesses should become more competitive. Horizon principal Graham Coleman says this means consumers want local retailers to be more price competitive. Retail New Zealand spokesman Greg Hartford says the results of the survey indicate Kiwis are unaware of the effects the status quo is having on retailers. He says retailers are working really hard to make sure they can deliver their products. The reality is that New Zealand is a small market and retailers are very small compared to international companies. We just don't have the scale to be able to negotiate discounts the way Amazon can, for example. He said, I understand that tax isn't popular, but GST is a key government revenue stream that underpins social expenditure. He says it's causing job losses and New Zealand town centres aren't as strong as they used to be. New Zealand Initiative Research Head Eric Crampton previously told NBR Online that applying online GST to low-value imports could backfire and deter online shopping. The majority of NBR readers appeared to agree with Mr Crampton, with 62% saying the application of GST would be bad for consumers compared with 38% who said it would be good for local retailers. About 21% of those in the Horizon survey admitted to showrooming, a trend where consumers go into a store to view or try items only to buy them online. This is up 6% compared to 2 years ago. The latest BNZ online retail sales report for May says total online spending was up 11% compared to May last year. Online purchases at domestic merchants was up 3%, which the bank says is a solid result following a seasonal dip in April. Spending at international sites was up 23%, although this reflects last year's figure being slightly lower than the trend at the time. New Zealand's $2.9 billion annual online purchases market still mainly consists of domestic sales, 59%, according to BNZ's December quarterly report. Compared to the 2013 quarter, the growth of international spend far outpaced domestic spend, 14.5% and 3.7% respectively. In court news, a 7-day battle between two accounting bodies kicks off at the Wellington High Court today. Certified Practising Accountants Australia, or CPA Australia, is suing the New Zealand Institute of Chartered Accountants, NZICA, for defamation. On a number of occasions, NZICA has said that CPA had inferior education standards, lack of global affiliations, misused membership fees, and a second-rate designation, according to a CPA statement of claim. In 2013, NZICA merged with the Institute of Chartered Accountants Australia as it faced competition from CPA. CPA claims a membership of more than 144,000 finance, accounting and business professionals in 127 countries. CPA alleges that NZICA Chief Operating Officer Kirsten Patterson said at events in Christchurch and Wellington that CPA wasn't a member of the Global Accounting Alliance because its education pathway isn't up to the same standard. CPA doesn't have the same beneficial global partnerships with accounting bodies. CPA wastes or misuses membership fees to pay for expensive television advertising, and CPA is a second-rate designation that has undermined the accounting profession in New Zealand. CPA Australia says the statements were false and defamatory, and as a result of their publication, its reputation had been injured and it's been subjected to public odium, ridicule and contempt. The statements meant it had suffered or is likely to suffer pecuniary loss in the form of damage to goodwill, reduced applications for membership and an increase in resignation numbers, it said. CPA solicitor Mai Chen of law firm Chen Palmer is seeking a declaration that the company has been defamed, costs and other relief. The accounting body is claiming damages of $50,000, costs and other relief. Further, CPA alleges the NZICA also breached the Fair Trading Act in a 2011 flyer it published for students comparing the rival organisations. In the flyer, NZICA stated the average annual salary for its members was $140,000, compared with $100,000 for CPA, that CPA has less rigorous standards and offers inferior training and mentoring upon graduation, and that CPA is not part of an international accounting alliance, according to the statement of claim. CPA says salaries on average are equal for memberships of both organisations. It requires extensive postgraduate experience and mentoring in addition to academic experience and online training. Its designation is globally recognised. It's an accredited body and it has international alliances with a range of accounting bodies. CPA Australia further cites a full-page advertisement published in the New Zealand Herald in October 2012 with a large font heading stating, "In accounting there's best practice and then there's second best practice." The ad stated that only a member of the NZICA had been exposed to the highest levels of industry training and development, which is why top CFOs and CEOs only employed chartered accountants. The ad and comments by NZICA Chief Executive Craig Norgate in an NBR article in May 2013 give the misleading impression, unquote, that members of CPA are exposed to inferior training, the statement of claim says. The flyer, advertisement and article constitute misleading and deceptive conduct and trade under the Fair Trading Act, according to CPA Australia, As a result, students and other candidates are likely to give CPA Australia reduced consideration, and it's likely to suffer pecuniary loss as damage to goodwill, reduced applications for membership, and an increase in resignation numbers, it says. Lawyers acting for NZICA declined a request for the statement of defence. Market news. The Commerce Commission is investigating PGG Wrightson over the fees the rural services firm, which is controlled by China's AgriCorp, charged during the implementation of a national livestock tagging program. The antitrust regulator will look at fees charged during the adoption of the National Animal Identification and Trading Act 2012, commonly known as NATE, the Christchurch-based agricultural company said in a statement. The Commission believes Wrightson breached the Commerce Act and will seek a pecuniary penalty from PGW. Chief Executive Mark Dewdney said the introduction of the NATE program was extremely challenging for the livestock industry, and PGW committed a lot of effort and resources into making its implementation as effective as possible. PGW considers that the NATE program is an important initiative to help protect New Zealand farming's key role as a primary producer and exporter. Wrightson has cooperated with the investigation and said the penalty, while significant, is unlikely to be materially price sensitive. NATE was an industry-based initiative which the government helped fund, requiring radio tags for cattle and deer and allowing nationwide tracing of livestock in a bid to bolster New Zealand's response to any biosecurity threats. In February, Wrightson reported a 47% gain in first-half profit to $19.7 million, and the 6 months ended December 30, beating analyst expectations. Operating EBITDA climbed 51% to $33.6 million, and revenue from continuing operation increased 3.1% to $654.7 million. Agria first invested in Wrightson in 2009 when the company was forced to raise new equity to repay bank debt during the GFC, after Wrightson's funding lines dried up and scuttled a bid to merge with Silver Fern Farms a year earlier. Wrightson shares were unchanged at 46.5 cents and have gained 1.1% this year.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To the EQC, New Zealand's Earthquake Commission may double its payout amount, scrap contents insurance and process claims through private insurers under the government's long-running review of funding and management of the state-run earthquake insurer. Associate Finance Minister Stephen Joyce and Earthquake Commission Minister Jerry Brownlee said in a joint statement, the government has released 9 proposals for public discussion as part of the review in a bid to simplify future claims and resolve difficulties between land and building cover highlighted by the Canterbury quakes. The review, led by the Treasury, was launched in September 2012 to consider the government's disaster contingency fund's future after its resources were exhausted by the Canterbury quakes that caused billions of dollars of damage and killed 185 people. Under the government's preferred reform package, proposals include private insurers authenticating and largely managing claims on the EQC's behalf, with terms to better align with usual insurer practice, building cover to also include site work to remove an overlap between land and building cover, doubling the cap on building cover to $200,000 while land cover would apply only where rebuilding is not possible. It would also lift the standard building claims excess to $2,000 from $1,000 per claim. EQC will scrap contents insurance and premiums will reflect the costs of running the scheme. The government will retain the Natural Disaster Fund and Crown Guarantee and will make clearer in legislation what the EQC scheme covers. New Zealand's level of insurance penetration is about 80%, with the EQC providing cover for the first 100,000, although under the proposals this would double on disasters including quakes, natural landslips, volcanic eruptions, hydrothermal activity, tsunami and natural disaster fires. Global reinsurers underestimated the cost of the Canterbury earthquake by about 50% after they were surprised by the impact of the liquefaction around Christchurch, while local insurance policies provided full replacement value cover rather than the international norm of sum insured. The review's terms of reference covered what the EQC insures, including the layer of loss covered, which natural disasters are covered, how multiple events should be treated, which types of property should be covered, the coverage of land, buildings and contents, what caps should be on the scheme and whether it should be voluntary or mandatory. According to the EQC's website, it has settled $8.56 billion of claims of its expected $12 billion liability related to the Canterbury quakes, with repairs to 97% of the almost 70,000 homes in the rebuild program completed. Of 167,613 building claims with the $100,000 cap, 5% are yet to be settled, with 41% paid out under cap, 39% repaired, 15% paid out over cap. It's also paid out 99% of its 187,000 contents claims and has yet to settle 21% of its 149,886 land claims. To our equity markets. New Zealand's equity markets plummeted in June, performing worse than any other developed or emerging market, according to the S&P Dow Jones indices. The S&P June scorecard reveals New Zealand is at the bottom of the heap, with the market index down 7.45% in June. This compares to Australia down 5.23% in June, China down 6.15% and the US down 1.87%. The index also reveals New Zealand performed worse than embattled Greece, which also defaulted on its $1.6 billion IMF loan last week. Hamilton Hinden Green Director Grant Williamson says as the report is based in US dollars, he's not surprised New Zealand performed poorly. He says the dip is in a large part due to the OCR cut last month. He said we saw about 6 or 7 days decline on the local market following the cut. Much of that was foreign sellers who were selling on the back of what would be a weaker outlook for the New Zealand dollar. He says if observed in New Zealand dollar terms, the NZX 50 lost roughly 2% for that month, but the currency effect was closer to 5%. But Mr. Williamson warns it's difficult to gauge a market based purely on a monthly basis. He says if the 3-year basis is observed, New Zealand is probably in the top 1/3 of markets worldwide. The S&P report shows New Zealand's equity market up 27.33% over the past 3 years. But Mr. Williamson says New Zealand's currency has changed its trajectory completely in the past few months and is trending down. He said the local market in New Zealand dollar terms has still performed well, and I think if we look outside and base it on US dollars, our market has been one of the best performing over the past 3-odd years. He adds that local investors won't be disappointed, but foreign investors certainly won't be happy as they've lost out on the currency. The S&P report revealed just 7 of the almost 50 global equity markets gained in June. Back to the Hanover settlement. Financial Markets Authority Enforcement Head Belinda Moffat says feedback from Hanover investors showed a strong preference for a quick settlement rather than a court trial, in what she described as a steady stream of contact since the regulatory investigation began in March 2010. She said what we know investors want is certainty now. We know there will be a range of feelings on a day in court, but the driving sentiment we have had is an outcome now. We couldn't deliver a court decision immediately, so our focus was on providing certainty through a settlement now. This morning, the FMA announced it had accepted $18 million from the former directors and promoters of Hanover Finance to settle allegations filed in 2012 that their investment documents contained significant false statements. The defendants in the claim were Hanover directors Mark Hodgson, Greg Muir, Sir Tiffany O'Regan and Bruce Gordon, alongside prospectus promoters Eric Watson and Dennis Broit. The 6 men denied the allegations and the settlement includes no admission of liability. FMA Chief Executive Rob Everett said the regulator traded off an admission of wrongdoing with recovering money for investors. He said, we genuinely believe that if we had gone to trial, the money on the table now would have been seriously diminished. So we had to make a trade-off of a court judgment of liability against what we could achieve now, and it was very clear to us throughout this process that an admission of liability was not going to come from the defendants, so we had to balance our objectives, and this is where we came out. In a statement issued through Public Relations Executive Nikki Shuck, Messrs. Hodgson, Muir, Gordon and Sir Tiffany said they had reasonable grounds to believe the prospectus statements to be true at the time and did not think the FMA would have succeeded at trial. They say, we decided to settle because of the cost and burden of litigation lasting for many more years and because our insurers and former insurance broker made it possible to provide a payment that will go to the investors. We are pleased that this result for the investors has been possible. We agree with the FMA that this outcome for investors and taxpayers is without doubt far better than any likely result after trial in future years. Ms. Moffat said previous cases taken to court by the FMA, including directors of finance companies Capital and Merchant, Lombard, Dominion and Nathans, showed it had established clear standards of disclosure. She said, I think the market does have a good understanding of what disclosure means and what we expect, which is about putting investors and putting customers first. Mr. Everett said the Hanover case involved an interpretation of facts rather than legal principles, so there were fewer benefits in going to court. The settlement will be distributed among about 5,500 investors in Hanover and United Debenture stock, as well as bondholders in Hanover Capital. A first payment to investors is expected in October this year.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
Back to the Hanover settlement. Financial Markets Authority Enforcement Head Belinda Moffat says feedback from Hanover investors showed a strong preference for a quick settlement rather than a court trial, in what she described as a steady stream of contact since the regulatory investigation began in March 2010. She said, "What we know investors want is certainty now. We know there will be a range of feelings on a day in court, but the driving sentiment we have had is an outcome now. We couldn't deliver a court decision immediately, so our focus was on providing certainty through a settlement now." This morning, the FMA announced it had accepted $18 million from the former directors and promoters of Hanover Finance to settle allegations filed in 2012 that their investment documents contained significant false statements. The defendants in the claim were Hanover directors Mark Hodgson, Greg Muir, Sir Tiffany O'Regan and Bruce Gordon, alongside prospectus promoters Eric Watson and Dennis Broit. The 6 men denied the allegations, and the settlement includes no admission of liability. FMA Chief Executive Rob Everett said the regulator traded off an admission of wrongdoing with recovering money for investors. He said, "We genuinely believe that if we had gone to trial, the money on the table now would have been seriously diminished. So we had to make a trade-off of a court judgment of liability against what we could achieve now, and it was very clear to us throughout this process that an admission of liability was not going to come from the defendants, so we had to balance our objectives, and this is where we came out." In a statement issued through Public Relations Executive Nikki Schuck, Messrs Hodgson, Muir, Gordon and Sir Tiffany said they had reasonable grounds to believe the prospectus statements to be true at the time and did not think the FMA would have succeeded at trial. They say, "We decided to settle because of the cost and burden of litigation lasting for many more years, and because our insurers and former insurance broker made it possible to provide a payment that will go to the investors. We are pleased that this result for the investors has been possible. We agree with the FMA that this outcome for investors and taxpayers is without doubt far better than any likely result after trial in future years." Ms Moffat said previous cases taken to court by the FMA, including directors of finance companies Capital and Merchant, Lombard, Dominion and Nathans, showed it had established clear standards of disclosure. She said, "I think the market does have a good understanding of what disclosure means and what we expect, which is about putting investors and putting customers first." Mr Everett said the Hanover case involved an interpretation of facts rather than legal principles, so there were fewer benefits in going to court. The settlement will be distributed among about 5,500 investors in Hanover and United Debenture stock, as well as bondholders in Hanover Capital. A first payment to investors is expected in October this year. To crowdfunding, a car-sharing company and a doggy treats business have both launched equity crowdfunding campaigns today on 2 different platforms. Peer-to-peer car share company Mindkin is attempting to raise a 20% equity stake of $390,000, which values the company at just under $2 million on new platform Crowdcube. The business says it will use the funding to hire staff and launch its groundbreaking technology platform Roam, which will let car owners hire out their vehicle to others through an online booking system and keyless car entry. Co-founder Andrew Kissling, an entrepreneur who previously founded Glazier Systems along with Intergen's Tony Stewart and Xero's Rod Drury, says internationally car sharing is already revolutionising the way we think about car ownership. It's about to do the same here in New Zealand, and Roam will be the most sophisticated offering in the New Zealand market. He says Roam works by giving people who don't use their car every day the tools to make money from it by hiring it out to people nearby or a select group of friends and neighbours. It means they can make money from their vehicle even when they're not using it. He says even if a car owner drives 45 minutes to and from work every day and uses the car for a few trips on the weekend, the car still sits idle for more than 92% of its life. The car owner uses the Roam website to decide availability and how much they would like to rent their car for. Once a car has been approved, a keyless entry system is installed. The first car is due to be running next month in Wellington, where the company is based. Insurance cover for car sharers and borrowers is currently being negotiated with IAG. Mindkin, which is being advised by Armillary Private Capital and Deloitte Private, expect to raise another $1 million in about a year's time, and says a trade sale or stock exchange listing could provide liquidity. The company expects to make a loss of just under $770,000 in the year to September 2016, but make a profit of almost $480,000 the year after that. In 2018, it expects profit to rise to $3.7 million. At the end of June, it had equity of just over $50,000, which came from an ASB bank loan and founder seed capital. The second campaign to launch today is for subscription dog treat service Bow Wow Box, which started a raise on the Pledge Me platform. The business under parent company Delivered to You aims to raise between $75,000 and $225,000, for a 5.3 to 14.3% stake. The Bow Wow Box website, launched late last year, has 400 subscribers who sign up for a monthly delivery of natural dog treats and has delivered more than 4,000 boxes so far. The company says its current subscriber base represents 0.09% of New Zealand's dog-owning households, so there is potential for growth. It points to the success of human food delivery services such as My Food Bag and New York-based BarkBox, which got 250,000 customers in 3 years to show demand. Founder Andy Evans says our goal is to deliver to 5 to 10% of dog owners. This would make the market size between 35 to 70,000 boxes a month. This will then allow us to expand into Australia within 24 months. He says we're also looking at a new product line, the cat equivalent Meow Wow Box. The company, which values itself at $1.35 million, says it made $78,148 revenue in the 2015 financial year and a loss of just over $52,000. This year, it expects to make revenue of just over $330,000 and a loss of just under $23,000. In 2017, revenue is expected to rise to $934,000 and become profitable with $80,000-ish profit. By 2018, it's forecasting revenue of $2 million and profit of $222,000-ish. It will use capital raised for marketing, sales and distribution, product development and working capital. To our dollar, the New Zealand dollar may fall this week as Greece's vote against adopting harsher austerity measures in return for another bailout stoked volatility in financial markets and adds pressure to the Reserve Bank to cut interest rates more deeply. The Kiwi may trade between 65 and 69 US cents this week, according to a business desk survey of 8 currency advisors. 5 expect the dollar will fall this week, while 3 have a neutral outlook for the currency. The Kiwi recently traded at 66.86, little change from 66.93 at the New York close. Greek voters spurned the extra austerity measures demanded by their European creditors to receive another bailout package, raising the prospect of the Mediterranean nation leaving the Eurozone and its shared currency. That's encouraged investors to seek safe haven assets such as the greenback, which has also been on the ascendancy on the prospect of looming rate hikes by the Federal Reserve. The Chicago Board Options Exchange's Volatility Index, known as Wall Street's Fear Gauge, spiked to a 6-month high in the lead-up to the referendum and was recently at 16.79, higher than the moving average of 14.64 this year. The heightened volatility in financial markets comes amid signs of a slowing local economy, where a plunging global milk price has sapped firms' optimism about the growth outlook and seen analysts raise their expectations for rate cuts by the central bank. RBNZ Governor Graham Wheeler started cutting the OCR last month, and traders are pricing in a 92% chance of a further reduction at next week's review. Imre Spies, a senior market strategist at Westpac Banking Corp in Auckland, said Europe will drive the rate outlook for the near term. The markets have already taken the view that Greece kerfuffle could be a big deal and will force the Reserve Bank to cut more. Over the year, we should get to 62 US cents easily. We've got a slowing economy here. The RB's cutting rates. The US is soon to hike rates, and there are global tensions from out of Europe. Traders will focus on headlines from Europe as Greek officials meet with their European counterparts on what will result from the no vote. Locally, the New Zealand Economic Institute of Research's quarterly survey of business opinion for the June quarter will be watched tomorrow for an update on business confidence after last week's ANZ Bank Business Outlook showed growing pessimism among firms, largely off the back of a souring agricultural sector. Other local data include June electronic card transactions and the May accommodation survey on Thursday and Friday, and the government's financial statements for the 11 months ended May 31st on Wednesday. Minutes to the Federal Open Market Committee's June meeting on Wednesday and a speech by Fed Chair Janet Yellen on Friday will attract attention for hints on the timing of higher US interest rates, while the Reserve Bank of Australia's policy review tomorrow and Australian employment data on Thursday will also be watched.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.